Thanks, guys. Wonderful to see a really full room this early in the year. Thanks all for joining us today. As everyone said, my name is Jolon Knight and I am an investment specialist with Hyperion. Hyperion's mission really is to sustainably grow our clients' capital over the long term. And to achieve this, what we're really trying to do is find that ultra quality growth companies that have superior and sustainable economics. And to do that successfully, we're really driven by our missions and values, which you can see on the screen here. We're a hardworking and a research-driven organisation. Our decision-making framework is evidence, merit, and first principles based. And first and foremost, we are alpha focused. This is what we get up in the morning to do, strive to deliver alpha. We see ourselves as long-term business owners, not short-term traders. The majority of our holdings, we've held for over 7 years in the global fund. And we think long-term, we're making all key decisions. And we're generalists who place the collective first. And the collective is you and your investors. We believe we have a unique and differentiated offering, which provides low fundamental risk through its simplistic and repeatable approach, which provides also material positive optionality across multiple areas, such as portfolio management and several disruptive long-term thematics, such as artificial intelligence and machine learning, which we'll talk a little bit about today and we're really, really excited about. Now, I mentioned we have a very repeatable process, and through that process, we can gain a lot of conviction for the companies that we invest in. A core part of our investment process involves investing in businesses that have disruptive strategies and technologies, and also have superior long-term economics. Superior long-term economics is really what's going to drive the double-digit EPS growth that we're trying to achieve. And when that compounds over the long term, that can really achieve attractive returns over time. What we really want to look for is strong and sustainable competitive advantages that forms a wide economic moat for the companies that we invest in. That's really important because that's the thing that's going to protect those intrinsic values in the long term. The second of which, what we're looking for, is a truly large addressable market. That's also important because it allows these businesses to grow and expand through time. And finally, we really want to see an innovative culture, as innovation breeds better products and also the creation of future revenue streams. Our investment process is a long-term valuation and calculated risk approach. It's really derived by two main documents, our financial model and our research template, which is standardised for every company that we look at. The financial model produces a 10-year terminal valuation, which in turn produces a 10-year internal rate of return, what we need to compound to get to that valuation. And the business quality score, the research template produces what we call a business quality score, which is a proprietary score for every company that we look at. And that represents a core component of our process, which focuses on the strength and sustainable competitive advantages to key stakeholders for every company that we look at. In a simplified approach, we take these two scores, the internal rate of return and your business quality score, and the higher the internal rate of return, the higher the weight in the portfolio. And from there, you need to risk adjust or right size the position. And we do that through 12 risk adjustments. And the ones you can see on the screen, is simplistically, confidence of achieving that terminal valuation, short-term, long-term predictability of earnings, confidence in management, the business quality score, and long-term innovation. We then feed that into our proprietary portfolio management system, which adds value over time to the returns that we generate. And this process is that forecast long-term risk-adjusted approach. We don't trade often, but when we do, we're generally contrarian in nature. All things being equal, if a share price is rising, there's no change to that long-term intrinsic value, there's no change to the business quality score, no change to those risk adjustments, we're probably going to be selling into that strength. And on the flip side, if the share price is falling, again, no change to intrinsic value, business quality score, risk adjustments, we'll be stepping in and buying. This is a very repeatable process, it's very structured, and it's responsible for 30% of our alpha since inception in 2014. We'd expect to see that to rise to around 50%, like we can see in both of our domestic products, which have been going for over 25 years. Now, we think differently to the market, we believe, and we try to exploit two key inefficiencies. The first of which is time arbitrage. And that's really just taking a longer term approach to investing what the market does. Market participants are generally very, very efficient on the short term. They're very close to businesses on year one and maybe year two. But if you can find a high quality group of companies that can retain their earnings, their sales, their return on capitals at high levels for many years, and we put as much thought into our 10-year numbers as our 7-year numbers as our 5-year numbers, you can produce what we call a beat the fade scenario, where these companies' growth, it doesn't revert to mean after years 1 and 2. And the quality anomaly is the second of which is a lot more rarer, but can really super turbocharge your returns over time. If you can identify a company that's doing something unique, something disruptive, something different, maybe they're reinvesting heavily on R&D, they're not at scale yet, they're disrupting the businesses and the dynamic of where they're playing, these companies can really grow to things that are really extraordinary. Think about an Alphabet, an Amazon, or even today with a Spotify, a ServiceNow, or a Tesla. The difference between us and the market, these are our forecasts out over 5 years. And you can see on the left of the slide here, on a sales in year 1 and 2, as I said, we're actually pretty close to the market. Market's pretty, we don't actually differentiate that much. We can be anywhere from 1 or 2% ahead. But if you push out 5 years, on the portfolio level, we're close to 30% ahead of where the market is, and on the median level of the portfolio, about 15%. But then when you move to the right of the slides, you can see our sales forecast versus the market. In year 1, again, anywhere from 5 to 10% ahead, but then again, when you push further out to year 5, we're anywhere from 60% on the portfolio level or 30% on the median. And what that means is if we are correct and our companies execute like we expect them to do, you can have a very, very large earnings upgrade cycle, which generally leads to share prices really rocketing up higher. The evidence of that can be seen for our portfolio versus the benchmark over time. Back to 2014, the global fund's EPS growth has compounded at around 21% per annum over those 10 years versus that of the benchmark of 10%. Those positive jaws that are opening up is effectively the alpha that we've produced. We're really excited what the future looks like. We've got EPS growing at around 22% per annum out over the next 10 years. What we're really starting to see in the last few quarters of reporting season is earning leverage really starting to accelerate through the portfolio. If you think back, even last year, you saw a lot of the big tech names, a lot of the big companies around the world cutting staff, cutting costs, really running their business harder. That's being really evidenced in the results that we've seen this year, where earnings have come through, not at the expense of revenue. And we think that'll become more and more obvious as this year goes on. Now, we have a concentrated portfolio. It's around 20 to 25 stocks, and they generally fall, these elite businesses generally fall into these 12 thematics that we have on the top there. And these thematics effectively are the structural tailwinds that are going to be the driving force of revenue and earnings in this decade and beyond. One that we're really excited about, and you've probably heard to sickness, is AI and ML, artificial intelligence and machine learning. Now, it's obviously captured the imagination of the broader marketplace over the past year, but really interesting to us, there's been a lot of this embedded in all 3 of our products, Aussie Smalls, Aussie Large Cap and Global, over the past decade. We're only really just getting to the point now where revenue and earnings streams are coming from them. And we believe that AI and ML is real, and we are potentially at the point of a paradigm shift, and where this can create a once-in-a-generational opportunity of increase in equity values, similar to what happened with the internet, with smartphones, cloud computing, and the proliferation of software. And we think this is really going to happen in around 4 phases. The first of which is really happening now, which is the selling of hardware to the hyperscalers, and that's like ASML that we have exposure to, which sell lithography machines to all the chip makers. The second of which is the cloud computing guys, so Amazon with AWS, Microsoft with Azure, Alphabet with their cloud services, and you've seen the reporting season's just gone that they're really benefiting from the acceleration of the need of high compute power in the cloud. The third part is the incremental software tiers. Most software providers have a subscription style service or a platform base. And it doesn't take a lot of an imagination for us that there'll be a premium tier that will come through. And we're already seeing that with Microsoft and their Copilot, ServiceNow and Salesforce both have AI products, and Palantir's been in the news just recently that they're here in Australia as well to help Coles out. And so we're really excited with the revenue streams that are coming through and the efficiencies that they are able to create for their users. And the fourth, which is probably the most exciting, is real use cases, getting AI into our hands as a consumer, whether that's through Tesla with their full self-driving, whenever that eventuates, Block with their point-of-sale terminals, Meta with the metaverse and the virtual reality. So there really is a lot to be excited about with AI and ML, and this isn't going to be a 1 or 2 year theme. This is a multi-decade process that could be very, very lucrative. We think our portfolio is further diversified as well. If you can see here, we own 22 names, but there's over 52 different underlying businesses and associated income streams within the portfolio that we own. Most of our large stock positions have several unrelated operations in distinct and separate industries. So even though we are concentrated, it is a very, very diversified portfolio by businesses. Now, obviously, we've had a tremendous year last year. We did around 69% performance, coming out of a fairly horrible 22, as most of you can attest. But what we really want to do at Hyperion is make sure that we're invested in market-leading businesses that can produce sustainable and substantial equity gains over the long term. If we're forced to take a short-term or a long-term view, it's always going to be a long-term because we think that is in the best interest of everybody and how you will be able to compound wealth over the long term. The 10-year internal rate of return for our portfolio is still sitting at around 22% per annum, which is still well above the long-term average for the portfolio. In conclusion, the long-term return outlook for our fund continues to look very, very attractive. The companies in our portfolio we think, grow by taking market share. They have sustainable competitive advantages. They definitely have a lot of pricing power and can grow at double-digit rates over a very long period of time. We believe the macro headwinds that we've faced over the last few years are in the process of turning into tailwinds. And we think we do have a very unique offering which provides very low fundamental risk through its simplicity and structured approach, while providing material optionality through portfolio management and these themes that we spoke about today. We'd invite you to explore our portfolio or our strategy further. And today I'd like to leave you with a quote from Benjamin Graham. To be an investor, you need to believe in a better tomorrow. And at Hyperion, tomorrow looks awesome. Thank you.